Hello everyone, welcome back to my YouTube channel. Today we are diving into the base stock method of inventory valuation. So what exactly is the base stock method? Let's break it down. Here the base stock method, it assumes that a minimum level of inventory called the base stock is always maintained. It means what? Company needs to maintain a minimum level of inventory. That is called a base stock, like 100 units or 200 units or 300 units. Like that, company needs to maintain minimum level of inventory. That is called the base stock. And out of the base stock, company should not issue anything. Clear? That should be the minimum level of inventory company should maintain. That is untouched. We should not issue anything from our base stock. This base stock, it is treated like a fixed asset and it is valued at its original cost. Clear? So always base stock that is treated as a fixed asset and that is always valued at its original cost. Like 100 units at rupees 10 means 10 it is our original cost. That is we need to value at the rate of 10, that is equals to 1000. Like that we need to always valued at its original cost. See here next, only the inventory above this base level, the fluctuating stock is valued using a regular inventory method like FIFO, LIFO or weighted average. It means what here? For example, base stock is 100 units and our total inventory is 250 units, right? So then what is the fluctuating stock here? Total inventory is 250 units. Out of this we need to, our base stock is 100 units, right? So then remaining means 250 minus 100. So 150 units is our fluctuating stock. So this fluctuating stock, it is valued using a regular inventory methods like FIFO, LIFO or weighted average. Clear? I hope this is clear to you all. Now, so in simple terms, base stock method, it is an inventory valuation method. So where a fixed minimum quantity of stock called the base stock that is always maintained and valued at its original cost. And while any inventory above this level, that is called as fluctuating stock, that is valued using another methods like FIFO or LIFO. See, for example, our base stock is 100 units at rupees 10 each. Clear? This is our base stock. This is untouched. Means we should not issue anything from this base stock. And next we purchased 200 units at rupees 12. And after that we issued 150 units. Now what we have to do? We have to issue from the purchase of 200 units. Why? We should not issue from 100 units because this is our base stock. We should not issue from 100 units. This is untouched. Clear? So cost of goods issued 150 at rupees 12, that is 1800, and remaining units out of 200 we issued 150. So remaining units 50 units at rupees 12 600 and our base stock is 100 units at rupees 10, that is equals to 1000. So our closing stock is rupees 1600. Clear? Now let's solve one problem. 1 minute. See here, a company, it follows the base stock method of inventory valuation. The base stock is 100 units at a cost of rupees 10 per unit. The following transactions occurred during April. April 1st, opening stock 100 units at rupees 10. This is our base stock. Clear? April 5th, purchase 200 units at rupees 12 and 10th issued 150 units. 15th purchased 100 units at rupees 14 and 20th issued 80 units. Valuation method for fluctuating stock, that is FIFO. Means first in first out. Means here oldest stock that we have, we need to issue first. Find the value of closing stock as on April 30th using the base stock method. Clear? Let's solve the problem. So here first we have to write down the base stock, that is 100 units at rupees 10. So April 1st, go to the balance column and write down 100 units at rupees 10, that is equals to rupees 1000. This is our base stock. I will underline the base stock here. Clear? So this is our base stock. See, this is our base stock. So this is untouched. We should not issue or we should not sell any base stock. Clear? Next, April 5th purchase 200 units at rupees 12. So on April 5th, go to the receipt column, purchase 200 units at rupees 12 means that amounts to rupees 2400. Now go to the balance column and write down. First we have to write down the base stock, that is 100, 10,000, and next write down our April 5th purchase 2400. Till here I hope this is clear to you all. Next, after that what we have to do, next April 10 there is an issue of 150 units. 150 units on April 10th. So go to the issue column and see, this is our base stock. So we should not issue anything from this. So from out of 200 units only we need to issue as per the FIFO method. So now this 200 units becomes our oldest stock. So out of 200 we have to issue 150 units. Clear? So 10th one, write down issue 150 units at the rate of rupees 12. That is equals to rupees 1800. Now go to the balance column and write down the base stock 100, 10,000, and out of 200 we issued 150 units. So remaining units 50, 12, that amounts to 600. Clear? Underline the base stock. We should not issue anything from this. Next one, April 15th purchased 100 units at rupees 14. So write down on April 15th 100 units at rupees 14 amounts to rupees 1400. So go to the balance column and write down. First we need to write down the base stock. This is untouched. Next, our oldest stock, that is 50 units at the rate of 12, that amounts to rupees 600. And after that our newer one 114,400. Clear? And after that let's see the last transaction on April 20th issued 80 units. April 20th issued how many units? 80 units. Now here in this our oldest stock, this is base stock, we should not issue anything from this, and here our oldest stock is 50, that is old, and 100 is our newer one. So as per FIFO method what we will do? First we will issue from our oldest stock. So first issue 50 units. We issued 80 units, but here in the oldest stock we have only 50 units. So first issue 50 units. 50 at the rate of 12, that amounts to 600. After that remaining 30 units we need to issue from the newer one. So 30 at the rate of 14. 30 into 14. 420. So now go to the balance column and write on first what we have to write. First we have to write the base stock 1000 and 50 we issued fully, and out of 100 we issued only 30 units. So remaining 70 units at the rate of 14 equals to rupees 980. So don't total it. So our 980. So our closing stock is 70 is rupees 1090. 980. So our closing stock that amounts to rupees 1980. So in this problem the base stock is 100 units at rupees 10. So that remains untouched and we apply the FIFO to the fluctuating stock. After all issues we are left with 70 units at the rate of rupees 14 in fluctuating stock. So adding both gives us total closing stock of rupees 1980. Okay, I hope this problem is clear to you all. If not, please leave a comment. And if anyone wants the solution of this problem and notes of this base stock method, please comment and I will upload in my Telegram channel and I will provide the link in the description box. Thank you.